Well, welcome back. This is session 5. So there are 2 more to go, up to 6. And get into the new frontier in asset pricing. And my name is Pietro Veronesi. I'm a professor of finance here for the past 26 years. And I'm joined here by 3 of my colleagues, Ralph Koijen, who is going to start at the back, Stephen Nagel, and Lubos Pastor. And Ralph, going to get started. We're going to start with in the introductory remarks, then maybe I may ask some questions, you ask some questions, and keep it fun. Go ahead.
Okay. Well, let me get started. So I'm going to talk a little bit about sort of like the use of demand systems in asset pricing. And it's going to connect a lot actually to the questions that Rob raised. So we've been sort of interested in very similar questions. So the basic starting point here is as follows. So if you think about sort of any asset pricing model, then we make assumptions on like technology, preferences, beliefs, information, and so on. Then you derive from that like the asset demand system, so what each investor wants to hold, where, I know, typically you have like some sensitivity to price captured by the elasticity, and then there's a demand shifter. And that demand shifter encodes all the information in terms of like what investors think about future cash flows, risks, or like Lubos wants to talk about values. All of that goes into the demand shifter. And then we impose market clearing and outcome like equilibrium prices. And so prices that we observe are size-weighted averages of those demand shifters normalized by elasticities. And so a lot of the work, what we do in macro finance is to directly go from like the first sort of like box to the third one, namely that we try to connect sort of like prices to like measures of fundamentals or using survey data beliefs and things like that. What we've been trying to do in what we refer to as demand system asset pricing is to think about frameworks that sort of at the same time explain prices and fundamentals as before, but also holdings and flows. And what I want to try to argue is why that's potentially useful and the kinds of questions you can answer with that. So I'm just going to give you a couple of examples from our work. And then in the second part, I'm going to sort of like argue that by inverting the asset demand system, there's actually a lot of information you can learn, and you can actually connect using recent methods that have been developed in machine learning and AI to get a lot of additional information compared to what we typically know. Okay, so the starting point here is to sort of like get after questions that, like were mentioned before today, questions related to like excess volatility and understanding kind of the dark matter of financial markets. One way to make progress on that is that the observation is that in traditional models, demand is very, very sensitive to movements in price. So demand is like very elastic. If you look at sort of like the recent literature, so there's lots of papers over here, using different like markets, different methods, and different ways of like getting identification, what you find is that demand tends to be a lot less elastic. So if prices move around, portfolios don't rebalance as quickly. And that has important implications because now you can start sort of like tracing back fluctuations in prices to the demand of like different investors. And so in work with like Xavier Gebex, we've like sort of implemented those ideas and developed a framework to measure flows and show that flows seem to be like more strongly correlated with markets. So now you can really start to think about like fairly small shifts in demand, moving prices a lot and generating excess volatility. Now you can extend this idea to like the cross section. So Rob mentioned these examples of like ARC and others. And so what we sort of like do in our work is to try to sort of like decompose valuation ratios, expected returns and realized returns, and trace it back to different groups of investors. So we oftentimes have like narratives related to, let's say, sentiment-driven like retail investors or smart money like hedge funds. And so what we can do with like a demand system is you literally decompose like movements in prices or valuations back to like the demand of each and every investor. And so, for instance, in some work that we did with Moderator and Rob Richmond, what you find is that, in particular, sort of like demand shifts coming from like hedge funds are very sort of like consequential for the cross section of like valuation ratios. And you can sort of look at different investors and try to understand these kinds of questions. The third example is sort of like at a broader level, sort of at an international level, where in work with Moderator, we sort of like estimated demand system like globally across global bond markets, equity markets, and currency markets. And what you can do with that is to understand questions related to like contagion. So if you go back to the sovereign debt crisis in Europe, then what we saw is that Greek yields, like they jumped up a lot relative to German yields. And in the model, that's sort of like very well explained by fundamentals. But then at the same time, you see that yields in peripheral Europe, like in Italy and Portugal and Spain, they also jump up. And then typically we refer to that as contagion, and that's pretty much where the story ends. Now, if you look through the lens of the demand system, then what you see is exactly like who's causing that contagion. So you trace it back to like the demand of different like countries, different investors. And so what you see is that during that period, the reason why the yield in Italy and Portugal and Spain and so on, why those yields jumped up was because like countries in the northern part of Europe, and in particular pension funds and insurance companies, that they withdrew capital from those countries, and that's why yields spiked up. Okay, and so again, it's sort of like understanding markets a little bit more like under the microscope as a way of like understanding what moves prices and expected returns. Now the last part that I'll talk about, or last example I'll give you as to why the demand system could be useful is that it may give you a new way of thinking about return predictability. So obviously a lot of people in asset pricing here have worked on these questions of like what predicts future returns, both in the aggregate and in the cross-section. Now the typical approach that we take is that you have a certain characteristic, and then that characteristic, let's say book-to-market ratio, forecasts like future returns. Now, what the demand system suggests is that you require pretty like special assumptions under which that is sort of like preferred or equivalent to an alternative, which is where you first predict the demand of each and every investor, then you add up like the predicted demand, you impose market clearing, and outcome like the future predicted return. And so instead of directly predicting the price, the equilibrium object in the next period, what we're predicting is a shift in the demand curve of each and every investor. And so we implemented an early version of that idea in an earlier paper with Moderator. And you sort of like what you see over here is that this helps you to forecast future returns above and beyond like the factors that we know. Okay, and again, sort of the broader concept here is that the demand system is a useful sort of like thing to study if in asset pricing. Now, one sort of like thing to point out is that the session is called New Frontiers. This idea is not very new actually. So if you go back to like, I don't know, the 60s and 70s and a bit of the 80s, there's actually a literature by like Tobin and Brainerd and Friedman and Frankel where people were estimating demand systems. Now, the thing is, if you look at those papers, then like the modeling frameworks were like not very well developed yet. Identification was like a huge issue, and the data was pretty poor as well. And so what we're really doing here is to sort of like build on those old ideas, but then using sort of like the new economic frameworks, like new methods and much better data than before. And we think at this point, sort of estimating demand systems kind of has become like a practical reality, and we think that this can be helpful to sort of like provide a new perspective on how markets function. Okay, so far that's the sort of the demand system part. Now, the second thing that you can do with the demand system is kind of like invert it. And so let me be like sort of like clear by what I mean with that. So obviously, like all of you have been made very aware of like the enormous progress that has been made by recent like AI methods in the context of like audio, language, and vision applications. Now, if you look under the hood of those models, then really what is the essence there is that it all starts from like learned representation of, let's say in the context of language models, it is all about the learned representations of like words, okay? And so the concept there that's really essential are something called like word embeddings. So what that means is that you're gonna map like every word to like a very potentially high dimensional vector, and then you can do like math with like words, okay? So the classic example that they have is like you take like Paris, that's a big vector, you subtract France, big vector, you add Spain, another big vector, you get another vector out of that, and that's Madrid, okay? So that's sort of the idea, and then these language models learn sort of like representations of words. Now, in economics, there's a lot of applications in like I/O, in corporate finance, and asset pricing, where we're also trying to understand the similarity between firms, okay? So we try to understand like firms that are in similar product markets. We try to understand firms that have similar investment opportunities, that have similar like expected returns, that are similar in terms of like riskiness. But the approach that we took in economics or finance is that we use observed characteristics. So we use like accounting data and things like that to find like what are the right controls to get sort of similar firms. And so the question that we're asking is like, is it possible to learn representation of firms and use sort of like similar AI models? And so the answer is you can. And one sort of like natural sort of answer would be like, well, you're just going to use text data to do that. But it turns out that there's actually much better data that we can use, and you can microfound. And that is actually the following logic, is that the way these language models work, if you think about how, let's say, OpenAI and others are training these models, is that they use like sentences, okay? And so what sentences do is they organize words and they find similarity between words. Well, we have like a massive industry out there of like portfolio managers who organize like assets into portfolios. And so what we do is we use like massive amounts of like portfolio holdings of lots of different investors, of like institutions and households and others, to learn like which firms are similar, okay? And the major advantage you have over text data is that if something changes in the economy, then the holdings data will change as well, how investors change their portfolios, and then you'll learn different representations of those firms. Now, what that allows you to do is that there's always this sort of like idea that we have, of course, like, I know, like going back to a lot of the work that Lars thought about as well, is that investors have like much more information than we have as an econometrician. Now, in lots of models, if you invert the asset demand system, you're actually kind of like getting at the same level as investors. And so that's essentially what we're doing. And so you can think about using the exact same modeling architecture as what people have used for like language and vision models, but now estimate those models using portfolio holdings and learn like which firms are similar. And then you can think about lots of applications related to like valuation, to like risk, to capture substitution patterns. And these sort of like learned representations, what we call asset embeddings, they tend to work much better than observed characteristics. Okay, so let me just sort of like stop with open questions. So there's many of them. In terms of like the questions we're interested in, from a theory perspective, like as I showed you before, elasticity seems to be much lower than implied by theories. Question is why? One sort of leading example is what came up already is that, well, the world is a complicated place. It's hard to learn. A lot of those models imply much lower sort of elasticities than in models in which you know a lot more about the environment. Questions about what drives demand shifters of investors, what moves demand curves around. Again, lots of like ideas here. You can make them more tangible. There's questions about inference. How do you model dynamics? How do you estimate those models? And then you can start thinking about sort of like making connections to other fields of like finance and economics. So you can sort of like think about, once you've estimated the asset demand system, you can think about solving the firm's problem that are optimizing, let's say like capital structure decisions and things like that, taking the asset demand system as given, and you sort of integrate corporate with asset pricing. You can embed these models into like sort of like more macro models, and getting much closer to what like Tobin and others were doing back in the day, but then with like the modern tools. In terms of applying these AI methods to holdings data, there's many questions, so a lot to do, I think. Thank you.
Okay, so I want to start with a caveat, which is, we're going to talk about future research here, and I think when you do something like this, talking about future research and things people could do in the future, you face a little bit an issue that's sort of similar to market efficiency, which is, if there was an idea out there that was important, interesting, but also feasible and somewhat easy to do, someone would probably have already done it, right? So with that caveat, let me talk about some ideas about where asset pricing could go. And I want to talk about expectations and beliefs. Expectations and beliefs are really crucial for asset pricing. We all know that. Asset pricing are very forward-looking. Asset prices depend on stuff far in the future. And so how expectations are formed is kind of crucial. And for quite a while, the field of asset pricing wasn't really interested in studying this, because everybody was working with models in which the expectations basically, jumped out of the model. You make assumptions about agents, and the agents know what's going on in the world. They know the parameters of the data generating process, and so the expectations just come out of the model specification and the parameters value that you plug in. So this is true, for the Lucas tree model, the way it's typically used of the CAPM and so forth. And this also has something to say about the role of the econometrician, right? So in this traditional rational expectations approach, where agents, know the parameters and the model of the world, the job of the econometrician is really just to uncover what agents already know, right? And so for that reason, it's totally fine for an econometrician to use a full sample of historical data and do an in-sample analysis and just uncover what the agents inside the model already know. And this matters and can lead to very different conclusions from some other approaches. Just one example, if you think about the yield curve and the way it moved over the years, right? In the early 1980s, we had very high long-term bond yields. And if you kind of take a standard kind of term structure approach to this problem, you would fit a vector autoregression with bond yields over the full sample until very recently. And what that vector autoregression would tell you is that, well, yes, bond yields, long-term bond yields in the early 1980s were very high, but there was a predictable reversion in short-term interest rates. Short-term interest rate would predictably come down in the future. And so you have these very high long-term bond yields, predictable decline in short rates. It must be that there's a big risk premium for long-term bonds, right? And this is sort of the standard conclusion that you get from many of these kinds of empirical studies that people have done. But if you look at forecast data from the time, you can look at professional forecasters or households, what were they thinking in 1981? You see that people were expecting quite high inflation rates going forward. People were expecting persistently high short-term interest rates going forward. And so it's actually not so clear that there was really that huge of a risk premium in long-term bonds. It seems like people just didn't, anticipate what eventually happened, which is that interest rates would come down again and again, and so far. Yeah? And so, for that reason, I think it's really important that in asset pricing we do more work to try to get inside investors' heads and understand how at given points in time, how they're making decisions, how they're forming beliefs that then feed into their decision. And there's of course been substantial progress on this in recent years, but there's still a lot to do. And I just want to talk about 3 avenues that I think are interesting. These are not, exclusively just the only ideas that are interesting out there, but to me personally, they seem like useful avenues to explore. And the first one is one that already came up today in Lars's talk, and also Nick touched on this, which is beliefs in a complex world, right? If you think about the problems that agents in our models are facing, and now I'm including models in which there's interesting stuff happening with beliefs because agents learn about the world and so on. Agents in those models typically face very simple problems. There's just a few variables they need to look at in order to make forecasts. There's only a few parameters that they need to learn. But if you think about decision makers in the real world, they face very complicated problems. If you want to forecast, short-term interest rates, there's a huge number of variables that could potentially be useful for forecasting interest rates. The same is true if you want to do stock valuation, you want to forecast corporate earnings. How do you select among all the possible variables that are out there to construct a forecasting model? How do they come together in a model? What are the functional forms? It's really a very difficult problem, and in some ways a lot more difficult than what we often have agents do in the models that we write down, right? And so I think there's an interesting problem of how do humans in the real world actually deal with that kind of problem? What are the simplifications that they're using to actually arrive at forecasts? And one kind of idea that I found interesting that has emerged recently is to think about machine learning kind of as an analogy for decision making of humans in very complex situations. One can also think about machine learning maybe as a benchmark for very sophisticated forecasting in a complex environment, and then we can think of behavioral frictions as some restrictions on those models, maybe simpler than most simple than just statistical optimality would call for, or maybe more sparse and so forth. So I was wondering whether this is sort of an alternative way of thinking about behavioral finance is in this way. Yeah. And we also see a lot more machines actually making forecasts and decisions. So maybe that's also a reason why thinking about machine learning for forecasting of agents and models is sort of a more and more useful way to approach this. So this was point one. The second point is I think there's still a lot that needs to be done to connect models of beliefs with data. I'm a strong believer in trying to connect beliefs data with data. So trying to connect assumptions about beliefs with data other than just asset prices. So we don't want to just, dream up some models of belief formation and then just tweak it in order to fit asset prices. I think we need other data from surveys, from holdings, from other things to try to discipline the way we model beliefs. And there's been quite a bit of progress with survey data in recent years, but for certain things, survey data will always be limited, especially when it go to a more disaggregated level, right? If you want to think about valuing individual stocks, there's not all that much we have. There's analyst forecast data, but beyond that, not that much. And so maybe we need some new ideas of how we can get additional data that sheds light on beliefs. I think textual information from earnings calls and other kinds of things are kind of interesting. Often they don't directly measure beliefs, but maybe there are things in there that we can connect to beliefs. And then holdings data and flows data I think is useful. Models of especially models of heterogeneous belief formation that will also make predictions about the positions that investors should hold in different kinds of assets. And so I think this is something that is kind of promising to shed more light on belief formation mechanisms. It is of course also not easy because there is a market clearing condition, right? And in that sense, it connects to what Ralph was just talking about. That if one wants to connect beliefs with holdings data, one also needs to have a good framework where there's a market clearing condition in there, and we kind of figure out how all of these demands from these different agents kind of fit together in equilibrium. That's the second point. And then the last one I want to make is about empirical methods in asset pricing. If you look at a toolkit that we teach PhD students in asset pricing, almost all of it is designed for rational expectations models in which agents know the data generating process and the parameters of the world, and then the econometrician's job is just to uncover what agents already know. But if you're moving to models where agents are learning, in which they don't know necessarily the right model for the world and so on, it's not entirely clear how we should proceed. There's of course always the possibility you write down a fully specified model and you estimate that model, that we can do. But I think one of the beautiful things about rational expectations econometrics is that it allowed us to do empirical work without necessarily having to write down the whole model, right? We can just use orthogonality conditions and then estimate models based on that. And I don't think we know a lot yet about how we could do something like this, where you only have specify limited parts of the model in order to learn something useful about models that are not rational expectations models and models in which agents are learning. I think a few things are sort of a little bit clear. So, for example, if you want to take a model in which agents are Bayesian learners to the data, there should be some sort of notion that returns are not predictable out of sample, so some sort of out of sample orthogonality condition instead of an in sample one. But I don't think we have much in terms of formal results that give us guidance on how exactly to do empirical work in this area. So I think that's another important area, and I think in general we should take much more into account that the world is changing, agents are learning over time about the world, and so their views are going to be changing, their views about models and parameters. And a lot of what we still do in empirical asset pricing is looking back at the history and thinking of things as unchanging, right? We look at factor premia and we say, there's a factor premium out there, and we treat it as if it's always there, when in fact it may actually be emerging and disappearing and so forth. So I think we need to think a lot more about structural change and about out-of-sample analysis rather than in-sample analysis, where we just look back at the entire historical data set.
That's great. Thank you so much. Lubos?
Thank you, Pietro. I'm going to stand up. I've been sitting too long. I'd like to talk about values. So we're supposed to talk about the future of asset pricing, and I see the future of asset pricing, or at least one important and bright, exciting part of this future in thinking about values, in moving beyond the traditional focus on risk and return. Okay, so in particular, people care about more than just risk and return. In fact, people care about more than just money. And as our society grows richer, these non-pecuniary values, whether they're climate or social justice or religion, are becoming more important. And if they're sufficiently important, we should be able to find some effects on asset prices. Okay? So to set the stage for values, I'd like to take a step back and think about what our field has to say about what people care about when they price assets. So as Ken told us at the beginning, first there was Harry Markowitz. Okay? So we all know about mean variance preferences. With Harry Markowitz, all people care about is mean and variance. Variance is the measure of risk. A little later, Sharpe and others explained that covariance with the market in particular was very important. That's what people care about when they price securities. A little later, we learned that covariance with consumption growth was essential to pricing securities. Okay? Then we learned from Gene and Ken and of course Merton and Ross that covariances with multiple factors are relevant for pricing securities. We're still talking about second moments, variance, covariance, multiple covariances. We learned from Cam and others that higher order moments can matter, skewness, co-skewness, etc. Note what all of these things have in common. It's a focus on risk. The idea is that riskier securities have to offer higher expected returns to compensate. And my point is simply that people care about more than just risk. Okay? It's not a new point. Of course, we know that people care about other things. We have known for decades that people care about liquidity. Amyhood and Mendelssohn, 1986, taught us there's a liquidity premium. Less liquid assets are less desirable. They have to offer higher expected returns to compensate. Doug talked about the convenience yield a little bit. That's, I view the convenience yield as closely related to a liquidity premium. And there's a literature on the liquidity risk premium, where the idea is it's the covariance of the security's return with aggregate liquidity that matters. So this is kind of a marriage between the traditional covariance perspective and the liquidity perspective. What all of these have in common is the importance of liquidity in asset pricing. But whether you talk about liquidity or risk, you're still talking about money. Okay? People just care about money up to this point. And my point today is that people care about much more than money. And of course, we all know that. We all know that people care about, their home country. People care about religion. People care about politics. I encourage you, next time you talk to a finance professional, ask them what they think about ESG or DEI or abortion or Trump, and you'll get a passionate answer. It's hard to tell what the answer will be, but it'll be passionate. Right? People care. And then ask them, what's the covariance of your portfolio with consumption growth? And I suspect you'll get a blank stare. And then even if you ask them, what's the Sharpe ratio of your portfolio, or what's the expense ratio of your fund, you'll probably get and followed by some guess, some numerical guess. So at the minimum, I think people care about certain things a lot, especially as our society grows richer. And I'm surprised that we've paid so much attention to things like covariances and so little attention to things that people are actually passionate about. Now, this is not to say that the focus on risk or liquidity has been misplaced, not at all. These are first-order effects that must remain an important part of how we think about pricing assets. I am simply saying that there are these additional things that people care about that should show up in asset prices. After all, if people are willing to pay the ultimate price to defend their home country, presumably they're willing to pay 1 or 2% a year for, to hold a portfolio that reflects their values. It's just not crazy to me a priori. There is some literature on this, obviously. This is not completely new. And just like in about any part of finance, Gene and Ken have done work here. Their 2007 paper on disagreement and tastes is one of the first papers that helped us think about, how taste for assets could could show up in a conceptual way. There's a beautiful graph in their paper. And then I've tried to do a little bit of work on this with my co-authors, Rob Stambo and Luke Taylor. And they may both be at Wharton, but they're really Chicago people. So just to be clear, Rob Stambo was a student here, Gene student actually, and he also taught here for a bit. Luke Taylor was a PhD student here. So this is really a Chicago, line of work, Pastor Stambo, Taylor, and we're all children or grandchildren, great-grandchildren of Gene, because Luke was my student. Anyway, so what we have done is we've tried to formalize some of these ideas, and we wrote down a simple equilibrium model, really the simplest model we could think of, where people care not only about financial wealth, but also about something else. Okay, we call it greenness, but it could be anything. And the idea is you have a utility function that includes financial wealth, but also includes, some tastes for assets. You derive utility from holding green assets and disutility from holding brown assets. The way to think about this could be either at the level of an individual that has a personal preference, or at the level of an institution that perhaps has a green mandate, or a pension fund that feels some political pressure to hold certain assets and not others. So I think you can justify these preferences. And then what comes out, a few lines of algebra later, is a CAPM-like equilibrium equation, which actually is the CAPM equation, but there's an extra term. Expected return has an extra component which reflects the greenness of the security. Greener assets have lower expected returns, have lower CAPM alphas. Okay, and of course, it's very intuitive. If people are willing to pay more for green assets, then you will see lower expected returns. People have, this is not our point. Cliff Asness has a beautiful, funny blog on this. We simply formalize this in a model where this comes out. Brown assets, put it differently, brown assets have to offer higher expected returns to compensate for the fact that investors dislike holding them. And this is not a new paradigm. It's new relative to the risk-return paradigm, but just like riskier assets have to offer higher expected returns to compensate for their risk, just like illiquid assets have to offer higher expected returns to compensate for their illiquidity, brown assets have to offer higher expected returns to compensate for the fact that they stink. Okay? The investors don't like holding them. It's simple. Anyway, we have a second additional independent reason for why brown assets have to deliver higher expected returns in equilibrium. The reason is that they're riskier. They are more exposed to climate risk. Basically, if you get a bad climate shock, which we view as a bad state of the world, brown assets tend to perform worse than green. And so green assets are a hedge, brown assets are riskier, brown assets have to compensate for this higher exposure to climate risk. And climate risk, of course, is non-diversifiable. Now, this perspective can help us understand not only perhaps some new questions, but also some existing facts. A couple of speakers in the morning talked about the value effect, how value has outperformed growth historically, but value just went through its worst decade in the past century. Like the 2010s has been like the worst decade for value, I believe. And it turns out once you recognize this greenness perspective, you actually come to understand why value underperformed. Value stocks tend to be brown. Growth stocks tend to be green. This is not a coincidence. In fact, it's predicted by our model. Green stocks will be expensive relative to book. Value stocks will be cheap relative to book. And it turns out green stocks had a really good decade in the 2010s. Green stocks had a really good decade because of an unexpected shift in preferences. Investors' tastes were shifting towards green stocks. So there was this unexpected high return on the green minus brown portfolio. And when you put the green minus brown portfolio on the right-hand side of the regression, HML's alpha all of a sudden goes from a big significant negative to essentially a zero, okay? Indistinguishable from zero. So maybe I should wrap up here. So I think the future of asset pricing is actually very bright, and I don't think we should feel constrained by, the shackles of covariance or anything like that. I think we can build on the important work on covariances and also think about additional things that people care about. So thank you.
Well, these were great talks. I have a bunch of questions here, but rather than me asking questions, let's hear from everybody. Maybe the young folks want to come in and ask questions to our panelists, or anybody else, or react to the lack of covariances. Anyone?
Hey, Lubos. So Cliff has this amazing point that like we hear all these divestment campaigns, but we don't hear a bunch of campaigns to like short brown assets, and I've wondered why.
Yeah. Yeah, shorting is un-American, and patriotism is also a value that people care about. So anyway, no, good question.
So, okay. So I was going to ask Ralph. I'm a big fan of taking the inverting demand and looking at unobservables you get from demand to asset pricing. One of the things that's typically been done is just to use the actual the choices of the flows, the things they do buy. But there's a ton of information on the stuff they didn't choose to put into the portfolio, right? So you can look at changes in weights, but you can also look at the set of securities that they could have invested that they didn't. Those are also associated with a bunch of characteristics. And I don't know if anybody's doing any work on that aspect or whether you've incorporated that in your work, but it seems like it would give you a whole nother set of things to look at that might help pin down the choices that they're making. Related to our earlier discussion, we don't get to see decisions that are made, right, by investment managers, but in some ways we can try to back out some of those by looking at what they do and what they don't do.
Yeah. So actually, sort of in the last paper I mentioned, so the asset embeddings, we actually use the extensive margin as well. And so it's really sort of saying like, okay, suppose I see like, let's say ARC's portfolio, and you rank the securities, you see how much they hold in each of them. The way sort of these like sort of typical AI models are being trained is sort of like you have a sentence and you blank out a word. Okay, so I went to the bakery and I bought like blank. Okay, and then you try to predict that. So we do the exact same thing, but then with like portfolio holdings. So you buy like, these are like the top 4 positions. So you buy like Google, Microsoft, and something else. Then you blank out the next one, and then you can choose all possible stocks. Okay, so not just the ones that you've had in the past or something like that, but it could be all like 3,000 stocks. And it's up to the model to find sort of like a representation of that firm. Okay, that sort of predicts that missing stock out of all of them. And then you can also start modeling the extensive margin as well. And so the way we think of it is that essentially we hopefully going to get much better characteristics out of like inverting the demand system, which we can then use sort of like subsequently in better modeling demand over time and extensive margin as well.
Question. So in terms of belief formation, based in belief formation, we typically form our belief from economically motivating prior without like financial frictions. For example, we typically impose restrictions on like risk-adjusted return as a prior. And in Stefan's book, he mentioned that we should think of how to like incorporate the prior with financial frictions or economically motivating prior with financial frictions. What will be the way that can best achieve this goal? For example, I think one answer in my mind will be using asset holdings data and intermediary asset pricing model, for example, to dictate some Bayesian, updating schemes or sort of. So, but I don't know what are the other answers for this type of questions.
Okay, so I'm not sure I can give a precise answer to this, and I'm also not entirely sure I understanding the question in the right way. But if I think about prior, let me just give one example, right? So if you think about priors about Sharpe ratios of assets that you could get, that would look different in a world where there's financial frictions and in a world where there's not financial frictions, right? So if you think that certain types of asset classes are more subject to frictions, that should maybe change your view about what sort of Sharpe ratios you might see in the data, and as a consequence, how much you should, shrink or not away from those kinds of Sharpe ratios. So, but I'm not sure whether that kind of gets to what you had in mind. But
I think Lars has the hand up for a little bit.
Okay, I'll go ahead. My question was just based on what you hear from practitioners a lot, and I know there is research on this, but I was hoping if you guys could just comment on what you think is most promising, and that is the bigger role the central banks are playing, in particular how monetary policy may interact with risk premia, how it maybe interacts with these portfolio decisions, and given how large they are in some fixed income markets. I guess I'm just asking, what do you think about the general area? What are the most exciting areas of research? Where should people focus when you're thinking about monetary policy and asset pricing?
Okay, let me go first. So I'll have a paper on Wednesday, next Wednesday, that is going to argue that, we typically think of monetary policy as having kind of effects in the short run. But maybe that's not quite right. Maybe if you think about, real rates kind of in a long run, maybe there are good reasons to think that there are also long run effects. So anyway, that's one tiny little slice of what you were asking for, but we'll talk more about this on Wednesday.
Any other comments on this pretty generic but
There's
important?
a couple of thoughts. So I think and my answer generally is going to be like any model you're going to write down where you have conventional, unconventional monetary policy, you're going to get like shifts in beliefs. And so then the question is essentially what you can do with a demand system is see whether if you have a certain mechanism in mind of which investors should respond, are reaching field, blah, blah, blah. To what extent that's actually sort of happening. And what's kind of funny is that sort of if you go back to the papers that I showed, there's one paper by Ben Friedman in the Journal of Finance in the 70s, which was kind of like who puts inflation expectations into the yield curve. And so I was really trying to understand, okay, why if the long end of the yield curve is moving, whose inflation expectations are we measuring? You can rewrite that paper now and you can probably publish it again. The paper is 50 years old, has 70 citations. It's completely sort of lost to sort of mankind. And so I think that's sort of it's kind of a good example where people are now trying to understand, let's say, why real yields are so high and things like that. And I think that's where potentially looking at sort of the demand system and try to understand who's buying or not buying these bonds could be sort of instructive. And then again, it's kind of just going to be a back and forth between what theories imply and what the data tells us. That's how I view it.
And if I can just complement Ralph's comments on bonds by thinking about equities, I could imagine that central banks' ability to intervene in times of trouble lifts equity valuations overall. Just that stock market investors are willing to pay more for equities because they know that they'll be bailed out, quote unquote, in times of trouble. I'm thinking the Greenspan put, the Bernanke put, etc. Pietro and I, Pietro, we even have a picture in our paper, one of our papers, some political uncertainty, where the fact that you can intervene in times of trouble lifts equity valuations. But I'd like to see more empirical work on this subject. To what how important is this put? How much does it contribute to equity valuations? I think it's a great question.
I guess just add one more comment. So I guess one key question is also, to what extent, in order to understand what central banks do to asset prices, to what extent do you need to think about heterogeneity here, in the sense that it affects what a few agents do and others are maybe passive, or to what extent can we understand this by just everybody's expectation gets moved, and so I think this is still not well understood.
Yeah, so my question's for Lubos. I certainly agree that covariances with other attributes is fair game and interesting, and I wouldn't want to rule it out by any means. But if I'm really going to put this kind of preference for greenness as part of the portfolio problem, not directly in the utility function, but as part of the portfolio problem, do you expect those same people that there's lots of evidence for greenwashing and for a lot of this stuff to be show and not real? Do you expect those same investors to start becoming much more vigilant about policing this type of activity and making sure that they're actually delivering on what's in the preferences? And then a related question is, if I really care about climate change, which some of us do for sure, other policy remedies are on the table. I can say, well, am I putting this on the utility functions because I think that governments are ineffective at addressing climate change, and this is the best way to do it for all investors to somehow collectively decide this is the right way to do it, or is it just because I'm going to feel better if my portfolio is somewhat more green and the overall social consequences are more minor?
These are great questions. Let me start with the second one. I don't think that green preferences are going to change the world. Okay, Could they be a small part of the solution to making the world a better place? Yes. The adjective "small" is very important here. I think we all understand we need some government action to correct externalities related to climate change, subsidizing the right R&D, maybe trying to enforce carbon tax. Good luck with that globally. It could be a small part of the solution in the sense that if enough investors care about this, then they will, they will increase the cost of capital of brown firms. They will reduce the cost of capital of green firms. Maybe not a whole lot. If enough people care, they will actually have a meaningful impact, and then investment can reallocate from brown firms to green firms. In addition, and this is sometimes underappreciated, if you have greenness in the utility function, that makes green companies more valuable, somewhat more valuable, and that gives firms an incentive to become greener. So even if, suppose I'm a CEO, and I'm one of Luigi's evil CEOs who only cares about market value. I'm a Milton Friedman CEO. I couldn't care less about the planet. Even then, I have an incentive to make my firm greener because doing so increases the market value of the company. So this is why I do think that there's some room to make the world a better place. But again, it's a small part of the solution. And I want to just one more comment. I think I'd like to distinguish two types of preferences here. Investors can have preferences for holding green assets just because it makes them feel better, like you said. And that's distinct from these so-called consequentialist preferences where you actually care about the world. You want to make the world a better place. These are two different things. And even if we agree that holding green assets doesn't make the world a better place, that doesn't mean that there's anything wrong with holding green assets, right? So people buy a painting for $1 million, hang it up in their living room, and they look at it and they derive pleasure from it. They're not making the world a better place. There's nothing wrong with having a preference for beauty. And in the same way, I think if people desire green holdings, we should make it possible for them to satisfy this desire and then work on the solutions in a different way.
Yeah, but my first question was about, okay, suppose I have these so-called green preferences. Do I really care about greenwashing, or is that, or as long as it looks on paper like it's green, I'm satisfied? And do you expect these same people to be much more vigilant about trying to, prevent greenwashing and do a much more careful job of kind of really making sure what it means for a portfolio really to be green?
No, greenwashing is certainly an issue. It is becoming less of an issue. The SEC is becoming concerned about this, although disclosure rules are still very modest in this country. In Europe, they have an SFDR, social sustainable finance disclosure regulation that's already, that can be used to enforce greenwashing behavior. So I think it's coming from the government already, and I expect more to come in the US as well.
So if you actually talk to investors, what they think is that by doing good, you do well. So they don't really believe that you take a lower return. Oh, sorry. If you actually talk to investors, they don't think that. I'm a loudmouth anyway. But okay, turn it off. Okay, so investors actually think that by doing good, you do well. That you get higher expected returns from green, not lower expected returns. So your paper will convince them that that isn't the way it works. If you increase the demand for these things, you raise the price, lower the expected return. So it's not clear how they'll respond to that. And if you look at money managers, they actually have the same belief. And the ones that know better hide their beliefs in the way they market their products. So they're not honest about what they expect these things to do. And the SEC doesn't monitor this stuff very well. So we'll see how it eventually plays out. Once a lot of papers get published saying this costs you in terms of expected returns, how much of it are you going to demand at that point?
If I can comment on this, I completely agree with you. If you look at the white papers, the research coming from the industry, it's predominantly saying green, green is good, high return. Of course, they have an incentive to put out white papers like that because usually the expense ratios on these products are a little higher. And then I want to bring this back to something that Rob Vishny talked about earlier, the importance of financial advisors. I think financial advisors should be talking to their clients about this too, and trying to elicit people's preferences. Just have a conversation with your client and see what do they actually care about. Tell me, and I'll put you in a product like that, and I'll explain to you how much you'll be sacrificing. And for some people, it'll be worth it. For some people, it won't be worth it. Well, we're talking about the future of finance, not today, not where we are today.
Hold on a second. Christian?
You have the microphone.
One comment to this. I agree 100% with Gene's point about how the finance industry, and I think it goes to Luigi's point about governance issues in the finance industry, has been sort of selling these assets with a higher return promise that, as you correctly pointed out, probably had to do with shifts into these markets as opposed to a fundamental premium. But where it does create distortions is that your point is that we could actually leverage the green preferences for real return concessions for projects that would actually address sustainability, right? And that's, I think it's actually a really interesting idea. It's sort of the idea of return concessions that we used in development finance that we could actually also use in green finance. But in order to do that, we need to be honest, and we need to basically sort out Gene's problem first, that people actually understand that they need to invest, and this connects with Lars' comment about greenwashing, that they need to invest in actual projects that address sustainability and not just hold stuff that somehow feels green or has a green label.
I guess you guys don't want to say anything to that. So, this is supposed to be optimistic panel. And I'll ask you something that I asked Gene, and he said that looking forward, one of the problems has been creativity in asset pricing. So I would like to hear what all of you have to say about that. I think maybe what he means is maybe data and computing. We have a lot of new data, a lot of computing, ChatGPT, and so on. So do you see all of this, what you have listed, being done in the next year? Or why not? What do you need to do everything if it's not creativity?
I guess, yeah, I'll start. Yeah, one of the things I mentioned was we need to connect beliefs in models with data that's not asset prices. And I guess the other creativity issue is, what sort of data could you use other than, of course we have the survey data, but how do you go beyond that? So how can we find other pieces of data that somehow tell us something about what's going on with beliefs? And so I think, yeah, that's a creativity issue. If somebody has an insight, okay, here's a new source of data that I can extract something about beliefs from, that will be a useful, step in progress.
I think, from my perspective, I think there's so much to do. I think, it's not a data issue. I think the data that at least we use, I think has been available since the 80s. I think to some extent data is endogenous. We now since developing the frameworks, a lot more data was kind of unearthed, let's put it like that. I think it's really just about developing the methodologies and developing the frameworks. I think it's kind of the same questions okay, how good are you at identifying credit supply frictions, and it's a question of identification. And here, at least in what we're doing, we're trying to understand estimating slopes of demand curves. We're trying to estimate those elasticities. We're trying to develop models where you have rich dynamics. The data doesn't look very much like our simple AR1 models, and so now how do you model those different investors? How do you model the insurance companies, the pension funds, the mutual funds, and so on? So I think there's so much to be discovered in terms of how you do the modeling, how do you think about it theoretically, and then do the inference. So I think next year is a bit optimistic. Am I very optimistic and excited about what we can do, and if this is successful, like what you can then answer with that? Yeah, very much so.
I completely agree with Ralph. I'm very optimistic about the future. Just think about what I've been talking about. If you want to, what kind of questions you can address in the values framework. Which values do people care about? Politics, which elements of politics do they care about? Religion, how important is religion in general? How about individual versus institutional investors? Where do the preferences of institutional investors for values come from, right? Is it political pressure? Is it the board? Who is responsible for this? In what states of the world do people prioritize pecuniary values over non-pecuniary values? We need to build bridges to political science. We need to build bridges to sociology in order to answer all these questions, and you need a huge amount of creativity to explore all of this. We have work to do for decades.
And I would say, if you look back at the programs, let's say the NBR Summer Institute, asset pricing over the years, I think in recent years we have seen quite a lot more in terms of kind of different approaches that people take and stuff like this, a little less conformity than some years ago. So I think people are trying to push in various directions. So yeah, I guess that also makes me optimistic that there will be progress in the future.
Okay, this is a question for Stefan. I'm curious on your take of the earlier behavioral panel where Richard was saying when problems are hard, we got to recognize that there's a force that goes in the other direction. If it's a hard problem that's important, people work more at it and you get more support and more of these things. So I was struck by your idea that you're going to use AI to try to approximate these things. But it seems like the first choice you're going to have to make is like how much sophistication do you want to vary with the difficulty or the stakes of the problem? So where do you come down on this question of when the stakes are higher, do you think we get things more or less accurate? It seems like there's a fork in the road. You can tell a story either way. So which way do you go on that?
Yeah, so I'm not sure. I guess it's at the end of the day an empirical question, right? So I think lots of plausibility reasoning would suggest that exactly what you said is true. But that's, to me, an interesting empirical question. Can we somehow figure this out, that when agents make decisions in complex environments and the stakes are higher, then the models are less simplistic. They are more trying to take into account the environment than in other situations. I guess there's also a question, time dimension, right? If agents have lots of time to process something, it's probably different than if they have to make decisions within, or even the machines have to make decisions within fractions of seconds.
So I guess maybe this is primarily a question for Ralph and Stefan. When we see people, taking models from computer science and doing some prediction tasks, like you talked about predicting which, asset is in a given portfolio, we can just take the loss function that they use when they do language stuff and reuse it. But a lot of times there are reasons for constraints to be put on beyond just the standard loss function. So for instance, if I'm adding an asset to my portfolio, I'm probably not going to add an asset that doesn't contribute to the diversification of the portfolio. And so you might introduce some penalty into the loss function to better capture, economic things that we have from our traditional models. And so I'm curious to get your thoughts on, like, if you had to introduce a constraint today to, let's say, cross entropy, what is it that you would add, specifically in the context of your paper?
Yeah, so I think it's a great question. So, and actually, I think it also relates to work Nick is doing. So, I think that's actually sort of two-way traffic. I think so far what we do in our kind of like first paper is we kind of like take the methods kind of like off the shelf and ask like, okay, what is the information we can extract from the asset demand system using those methods off the shelf? And how do they compare to like a large set of like observed characteristics? And we find that these methods are useful. Now, if you look at what these methods do, it's just a massive number of parameters with like huge amount of regularization with like zero sort of like economics in it. And so the hope is that actually sort of by bringing in the economics, we can actually impose constraints on those models. And so one of the big challenges I think that they have with those models at this point is that you need to give it like massive amounts of data, and then it can do like pretty impressive things like we've all seen with like ChatGPT, but it's kind of surprising that like my 5-year-old at home can do like a lot of things without having read all of like Wikipedia and the Toronto Library that these models still can do. And so they're kind of struggling how to get sort of like more sort of like, and how do you learn more efficiently? And so potentially sort of by bringing sort of like economic constraints into the way we're estimating these models, we extract the information even more efficiently. So I think I don't have a good answer for you now in terms of like how to do it, but sort of the observation is that even the off-the-shelf models without those constraints do surprisingly well, which gives me a lot of sort of like, I know, interest in developing, okay, which kind of constraints would work and what does it tell us about behavior, and sort of can we have a back and forth between those methods and just sort of like economic like theory.
Yeah, so I actually have a recent paper with Sahi Kozak and Sri Santosh that is sort of precisely trying to get at this question, right? So there are these machine learning tools one can use to try to predict returns and then construct, optimal portfolios or an SDF. And you could just take them off the shelf. But then, is that the right thing to do? And so what we were trying to think about is, can we bring in a little bit more, just a little bit of economic reasoning? And what you often do in these machine learning approaches is you apply regularization to discipline your estimation. And this brings up the question, what's the right way of doing it? Again, off the shelf, or can a little bit of economic thinking tell us about what the right way of doing it is? And so we kind of do this under the view that, finding extremely high Sharpe ratio opportunities would be something that's weird. And so we sort of impose priors that say this is unlikely. And this then leads to a different form of regularization that you would get from sort of off-the-shelf approaches, exactly with that kind of motivation that you mentioned. Yeah.
If I can add just a sentence to this, you might also add an asset to your portfolio if it has no diversification benefits, just because it makes you feel better, or because you can tell your friends at a cocktail party that you're holding such an asset. Maybe you can tell your regulator you're holding such an asset. So. Yeah.
Essentially out of time, but see there is one last burning question, so let's hear it.
It's a quick question
yes,
for Ralph. I'm wondering if you think of the asset embedding thing as a promising way forward to bridge across asset classes, particularly ones that don't share characteristics, like bonds and stocks have different types of characteristics, other ones too, but you can still think of them in sort of the investor's portfolio, predict what bonds they hold based on what stocks, and given that we have different pricing models for bonds and stocks and whatnot, do you think this is a promising way forward to sort of think about the relationships between different asset classes?
Yeah, for bonds for sure, because like you could sort of imagine sort of bringing in bond portfolios as the same underlying firms, just different part of the capital structure. So there you could sort of find like whatever bonds are similar in investors' portfolios and equities as well. Thinking across asset classes, I think there's a broader set of issues in terms of like the asset demand systems, like why, for instance, elasticities seem to be quite different across asset classes. So generically, they're much lower than theory, but people find sort of like somewhat higher elasticities for like treasuries, then somewhat lower for corporate bonds, somewhat lower for like equities. And so what is kind of the theory that tells you based on what fundamentals I can predict in different asset classes, what the elasticities are, what the volatility of flows is, what is the excess volatility. So I'm very interested in that set of questions, and I know we have some thoughts on that, but that's sort of like where I'm at. Yeah.
Okay, let's thank our panelists. Thank you.